Welcome back to Talk Tickers. It is Friday, January 23rd, 2026. And if you are staring at your portfolio this morning, wondering why there's this massive crater where a stable, boring dividend aristocrat used to be, you've definitely come to the right place. Today, we are focusing entirely on the Abbott Laboratories Q4 2025 earnings call. And I have to say, looking at the screens, it is ugly out there.
Crater is honestly the right word. I mean, when you talk about a stock like Abbott, you expect a pothole, maybe a speed bump. You do not expect a sinkhole. We have a lot to unpack here because this is one of those quarters that doesn't just lose money. It really shakes your faith in the whole narrative.
We have to start with the vibe check. There's just no ignoring the elephant in the room. Abbott ticker ABT closed yesterday, January 22nd, at $108.61. That is down roughly 10%. We're talking about a drop of over $12 a share in a single session. Right. For a tech stock, maybe that's a Tuesday. But for Abbott, why is the market freaking out like this over a healthcare giant?
Because it just defies the physics of the stock. You have to remember, Abbott is what we call a low beta stock. For those who don't track the Greeks, beta measures volatility. A beta of 1 means you move with the market. Abbott is, usually way below that.
That's supposed to be the safe one.
Exactly. It's the defensive play. It's the stock you buy so you can sleep at night. A 10% move that's something you expect from a biotech startup waiting on a binary FDA decision.
Heads we win, tails we go to zero.
Right. You do not expect it from a diversified healthcare giant that's been around for over a century.
So people bought this for safety, and they woke up to a panic attack.
Yeah.
And here's the setup that makes this so confusing. Abbott actually beat on earnings. They expanded their margins.
Yeah.
If you just looked at profitability, you'd assume the stock is up or at least flat. But the market, it treated this report like a crime scene. Is this just a classic case of numbers versus narrative?
That is exactly the tension we're seeing. The numbers, specifically on the bottom line, were fine. Good, even. But the narrative took a massive hit. This was a credibility reset. Investors looked at that revenue miss, they looked at the specific segments that are dragging, and they decided that management might be losing control of the top line.
And top line growth is everything right now.
It's everything. In this market, if you can't grow the top line, nobody cares how much money you save on the bottom.
Okay, so let's get into the specifics. Why did a decent earnings beat result in one of Abbott's worst single-day drops in decades? I've gone through the transcript, and it seems like it's not so much about what worked, because parts of the business are doing great.
They are.
But about what broke. And looking at the breakdown, what broke seems to be nutrition.
That's the anchor dragging the whole ship down. But before we dissect the disaster in nutrition, let's quickly hit the headline results so everyone understands the baseline we're working from.
Right. Let's do the snapshot. On the bottom line, they beat. GAAP diluted EPS came in at $1.01, and the adjusted diluted EPS was $1.50.
And the consensus on the street was hovering around $1.49 to $1.50.
Yeah.
So they edged it out.
A penny beat at the top end?
A penny beat. In a bull market, that's usually a good enough print. It keeps the algorithms happy because you technically hit the target.
But then you look at the top line. Revenue came in at $11.46 billion.
And this is where the trouble starts.
Now, on paper, that is up 4.4% year over year. Even if you strip out the COVID testing noise, it's up 3.8% organically, and it's a big beat. But it missed the consensus target of $11.8 billion.
Just sit by about $340 million.
And that's the number.
That's the number that triggered the sell algorithm. You have to understand, in this specific economic environment, revenue growth is the premium metric. If you're cutting costs to make your EPS target, but your actual sales are slowing down, the market views that as low-quality earnings.
Like squeezing a dry sponge.
Exactly. Eventually, there's just nothing left to squeeze.
Speaking of squeezing the sponge, though, I was actually impressed by the profitability. They posted an adjusted operating margin of 25.8%. That's up 150 basis points year over year. I know basis points is banker talk, but for a company this size, moving margins by 1.5% is heavy lifting, right?
It is massive. Management executed perfectly on discipline. They controlled what they could control: expenses, supply chain, overhead.
And in a normal market.
In a normal market, expanding margins by 150 basis points usually gets you a standing ovation. It shows operational leverage, it shows efficiency.
But hey.
Today, it was completely ignored. The market looked at that efficiency and said, great, you're efficient, but why is nobody buying the baby formula?
It really was brutal, and the volume confirms it. We saw 37.1 million shares trade hands yesterday.
3 times the normal daily average for Abbott.
3 times.
That is a high-volume exit. That isn't just retail investors getting spooked because the line went down. That is institutional capitulation. That is big funds looking at the thesis, seeing that revenue hole, and deciding they don't want to stick around to see if it gets filled in 2026.
Okay, let's do the deep dive. We need to figure out where that $340 million revenue hole came from. And I think we've identified the main culprit. It's the nutrition segment. Sales fell to $1.94 billion. That's a drop of 8.9% year over year.
This is the disaster zone, Abbott's nutrition business. We're talking about massive brands like Similac, Ensure, Glucerna. This is supposed to be the steady Eddie of the portfolio.
A consumer staple.
It's a consumer staple. People need to eat, babies need formula, but it dropped nearly 9%. I mean, that is a staggering decline for a staple business.
What's actually happening there? Is it just that people aren't buying baby formula? Or is there something else going on? Because babies still need to eat, last time I checked.
Yeah, it's more complex and frankly more concerning for the broader economy. Management cited pricing and competitive pressure and specifically noted adult nutrition softness.
Which is corporate speak for?
For we raised prices too high and people stopped buying.
So it's an elasticity issue. People are finally pushing back on price.
Precisely. This is the elasticity debate we've been seeing across the entire consumer goods sector. For a long time, companies thought they could just pass inflation onto the customer. Oh, costs are up. We'll make Ensure $15 a pack instead of $12. But now the consumer is pushing back. They're switching to store brand generics or they're just buying less.
That is a huge red flag. This segment was supposed to be a stabilizer.
It's the whole point.
Right. The whole point of owning Abbott is that when the high-tech medical devices are volatile, you rely on people always needing nutrition products. But instead, it's become this massive headwind.
And that's the swing factor because it challenges the defensive nature of the stock. If Abbott loses pricing power in nutrition, margins will eventually compress there too. That 8.9% drop is a loud signal that the brand loyalty might not be as strong as they thought. And you have to wonder, is this temporary? Or is this the new normal where generic brands just eat their lunch?
Then you have the other drag, which is Diagnostics. Sales came in at $2.46 billion, down 2.5%. Now, we knew COVID was over, right? We've known that for years. Why is this still dragging down the numbers?
This one is a bit more forgivable, but it's still annoying for investors who just want a clean quarter. We knew COVID testing revenue was running off. That's the COVID cliff. But on top of that, they cited a softer than expected respiratory season. Flu and RSV weren't as bad as predicted this winter.
Wait, so because people were healthier than expected, Abbott missed their numbers? That feels incredibly perverse.
Welcome to healthcare investing. Bad news for public health is often good news for earnings. Fewer sick people meant fewer tests sold. It's not an operational failure, but it's another reason the revenue number came in light.
So nutrition's broken because of prices, diagnostics is shrinking because fewer people are getting sick. It begs the question, was anything working at Abbott this quarter?
No, and this is the frustrating part for the bulls. The growth engine is actually intact. Medical devices and established pharma performed well.
Right, they highlighted new launches, momentum in electrophysiology, structural heart, and diabetes care.
Yes, that's the good stuff.
I keep hearing about electrophysiology. Can we simplify that? What are we actually talking about?
Think of it as the electrician work for the human heart. It deals with heart rhythms, AFib, irregular heartbeats. Abbott has incredible technology in this space, specifically ablation tech. Imagine a tiny catheter that goes into the heart and burns or freezes small areas of tissue to fix the rhythm. That, along with the Freestyle Libre franchise for diabetes. These are world-class, high-tech products. They are growing. The strategy is working on that side of the house.
So the high-tech stuff works, but it doesn't matter right now, does it?
Not today. The strategic takeaway is that medical devices is supposed to be the durable engine of the company. And it is working, but right now is being totally overshadowed by the consumer health slump. It's like having a Ferrari engine in a car with 2 flat tires. You aren't going anywhere fast no matter how good the engine is.
Let's look forward, because usually, if a company misses a quarter but gives great guidance, the stock can recover. Wall Street loves a good comeback story.
They do, but that didn't happen here.
No. Let's look at the outlook. For Q1 2026, management guided for adjusted EPS of $1.12 to $1.18.
And there's the second kick to the gut. The street consensus was around $1.19, so they're starting the year with a soft guide.
Which you never want to see.
You never want to see that when the stock is already under pressure. It tells investors that the pain isn't over. It suggests that the nutrition issues are going to bleed into the first quarter of this year.
However, And this is where it gets confusing and, frankly, a little hard to believe. For the full year of 2026, management reiterated their outlook. They didn't cut the full year.
No, they held firm. They're still calling for organic sales growth of 6.5% to 7.5% and adjusted EPS of $5.55 to $5.80.
This is where the skepticism comes in, right? The midpoint of that full-year guide implies about 10% earnings growth.
It does, but they just told us Q1 is going to be soft.
So if Q1 is soft, but the full year is strong, that math requires a miracle in the second half, doesn't it?
It implies a hockey stick recovery. You know the shape on a chart flat at the beginning, then shooting straight up at the end. Investors hate hockey stick guidance.
Feels like hope.
It feels like management is saying, don't worry, it'll get better in Q3 and Q4. But after missing this quarter, the market isn't willing to give them the benefit of the doubt.
It just adds more risk.
A ton more risk. If they miss Q2, the whole year falls apart.
And on top of all this operational drama, there is this massive strategic move happening in the background. We have to talk about the Exact Sciences subplot.
Right. The pending acquisition. They're targeting a close by Q2 or mid-2026.
This is a huge deal. It brings in Cologuard and a massive cancer diagnostics platform. But looking at the stock drop today, does this deal help or hurt the current situation?
It adds complexity. In the long run, the strategic logic is sound. It gives them a second massive growth engine alongside medical devices. But in the short term, it raises the stakes significantly.
How so?
Management now has to integrate a massive acquisition, which is never easy, while simultaneously fixing the broken nutrition business.
That is a lot of spinning plates.
It's a very high bar for integration messaging. If they take their eye off the ball in nutrition to focus on integrating Exact Sciences, things could get worse. The market is thinking, can you guys really walk and chew gum at the same time right now?
Especially when your house is a bit messy. Let's zoom out and look at the investor context. It has been a rough month for Abbott holders. The stock is down 13.3% over the last month.
And you have to contrast that with the sector. The XLV, the healthcare ETF, is up 1.9%. The broader market, the SPY, is flat to slightly up.
So Abbott isn't just falling with the market?
No, they are severely underperforming their peers. This is an idiosyncratic, company-specific breakdown.
That's painful. It feels like the narrative has shifted completely. A year ago, the story was steady, reliable growth.
The narrative used to be Abbott is the safe harbor. Now the narrative centers on three things: nutrition pressure, the COVID runoff that won't end, and deal execution risk.
A sobering reality check. But as we always do on Talk Tickers, we like to look at the chaos and see if there's an opportunity.
Just because the building is on fire doesn't mean there aren't valuables inside.
Right. Disclaimer time.
Always.
We are moving into our This Is Not Financial Advice segment. We are just two voices on a deep dive. We are not your financial advisors.
Do your own due diligence.
Do not blame us if you lose your shirt.
Absolutely, please don't. But let's put on our hedge fund hats for a minute. Imagine I'm an analyst at a multi-manager pod shop, and I'm pitching an idea to my investment committee.
Okay, set the scene.
Yeah.
The stock is down 10%. Everyone is panic selling. What's the thesis?
The thesis is called the implied volatility harvest. Here's the observation. The market reaction, down 10% on 3x volume, is a capitulation event. It's panic. And when there's panic, the options market goes haywire.
Okay.
We're seeing heavy put activity. People are buying puts to protect themselves, which drives up implied volatility, or FIVE.
Explain FIVE like I'm five, because I hear that term thrown around a lot.
Think of IV as the price of insurance. When the weather is sunny, flood insurance is cheap. When a hurricane is currently ripping the roof off your house, flood insurance gets really expensive.
And right now, Abbott is in a hurricane.
Abbott is in a hurricane, so the premiums on the options are sky high. People are paying a lot of money to insure against further downside.
Okay, so how do you play that?
The logic is this. The core medtech business, the device is fine. The margins are great, remember? Up 150 basis points. The market is pricing Abbott like a broken growth story because of Insure shakes and baby formula. I think that's an overreaction.
So what's the trade? How do we exploit this expensive insurance?
I call this trade the synthetic nutrition spinoff.
I love the name. Break down the structure.
Here's what we do. We sell the elevated downside, but let's look at the $100 strike price. We are selling that expensive flood insurance to the panic sellers. We take that rich premium we just collected, and we use it to finance buying slightly out of the money calls, specifically LEAP EPS for 2027.
Okay, let's unpack that. You are selling insurance to the people terrified it's going to zero and using their money to bet on a recovery.
Precisely. We are essentially acting as the insurance company for the panic. We're betting that the nutrition drag is fully priced in at $108. If the stock just stabilizes, doesn't even have to skyrocket, or if the Exact Sciences deal closes smoothly, the multiple will re-rate.
Why is this outrageous but plausible?
It's outrageous because you're stepping in front of a freight train. You're selling puts on a falling knife. But it's plausible because you're buying the margin expansion for free. You're getting exposure to the good part of the business, devices, while getting paid to take the risk on the bad part, nutrition.
And we have to state the risk clearly, because if this goes wrong, it goes really wrong.
The risk is you catch a falling knife. If the nutrition segment spirals out of control and Q1 misses the already lowered guidance, the stock could flush to $90. In that case, because you sold that put, you're obligated to buy the stock at $100. You'd be owning the stock at a loss immediately.
So don't do this with rent money.
Never do this with rent money. This is for the risk capital bucket only.
The pod shop tagline.
We are fading the headline panic to buy the margin expansion for free.
Bold, risky. I like it. But again, not financial advice.
Definitely not.
All right, let's wrap this up. Recap for the listeners who might have zoned out during the option strategy.
Simple summary. Abbott delivered on margins but failed on revenue. Nutrition is the anchor dragging the ship down. It dropped nearly 9%. The market punished them with a 10% haircut. It's ugly out there.
It certainly is. We'll be watching to see if they can turn that nutrition ship around in Q1.
And here's a final provocative thought to leave you with. Management reaffirmed the full-year guidance despite the bad Q1 guide. That implies a massive back-half recovery. So the question is, are they seeing a pipeline explosion in devices that we don't know about yet? Or are they just hoping the consumer recovers before Q3?
And if they miss the next quarter?
If they miss the next quarter, you have to ask, is the CEO's seat getting hot? You can't promise a hockey stick recovery and then deliver a flat line.
That is the multi-billion-dollar question. We'll be watching the ticker. This is Talk Tickers.
Stay sharp out there.